Good afternoon, Scott Redler, T3 Live. Welcome to today's recap. So we came in, market was pretty flat. And then after, I would say about the first half hour or so, it really felt like the indices were a bit heavy. Yes, we had a few nice bounces in Apple and Google. So there was some strength in the financials. But we tried to be long some indices and they just were being sold. We also came in today saying that there's been a lot of weakness in tech. We've talked about how weakness in tech is something that you just don't ignore. Usually in a more constructive / healthy environment, tech leads us to the upside. You also have usually the Russell leading us to the upside, and then there's typically momentum. And if you recall, last Friday when we had the jobs number, market opened up and we failed. A lot of stocks were sold. If momentum leaves situations, you leave, especially if you're playing for momentum. And then we broke, the accelerated trend that's been holding this market since August. So, if you're a shorter term, more active player, it paid to get more tactical versus portfolio approach. I think if you follow me on the virtual trade floor, you saw that I think on Thursday, Friday, I might have had 5 to 7 longs with 1 short. And then by the time Friday's end of the day, I sold some strength, got stopped out of some scenarios, and I went back to being tactical because to me the market had a lot to prove. It's been a big run. We've done very well trading the market, holding the market with a portfolio approach when the market deserved it, and now we're at a point where if you did sell some strength, or perhaps when when you saw the Qs break the 50-day, you got out of more stock. Tomorrow could be interesting if we get another one of those down days. If you look at the chart of the S&P, you'll see that from the October 4th low about a year ago, macro investors not even sweating. Okay, from 1100 all the way up to where we peaked out around 1474. Really, really nice move. If you're a shorter term guy, which is like us that tries to play the intermediate move, something a little different. Okay, it was a few different red flags. This was your 1474 high. Remember, this was a nice gap and go breakout. Here was your bull flag where you could have added. Here was when the oscillator went plus 60. Plus 60 is way overbought, a time to sell some. That was a time we talked about lightening up, sell some excitement. Then if you recall, this flag type pattern that wound up getting resolved to the downside. Okay, but what did we do? We held this accelerated uptrend that was intact since August 3rd, or since actually July-ish. This was that August 3rd right here, different day. That's when we really started to, I think that was when I think we made the bulk of our money over the summer on this move right here. But anyway, first time we got down here, you remember we were buying. It was, I think I broke the rules as a good Jew when I started tweeting about buying on on this support on this trend line, and then we rallied back up. Then here's your push through failure, okay, which is another short-term bearish signal. We'll take a close look there again so you could see it. Push through, came back below, a little bit of a red dog reversal. Then from there, what do we do? This time we broke this accelerated trend line to come back and almost get to the 50-day, which we talked about early in the day. Reason we were pretty adamant that we can get there is look at the action in the Qs. Okay, remember we talked about the Qs leading the weakness to the downside. Here is that small, just like ascending little channel right here that wound up getting broken to the downside with some potency, really. And then we, it rallied back up, and then on that Friday, the Qs were much weaker than the overall market. Like, look how the Qs opened up, closed at the dead lows with a wide range red bar, where if you look at the spiders on that same day, not quite as drastic, but, so at that point, you had to be a little bit on alert, plus the weakness in Apple. So here's the 50-day, didn't look back, broke below it. Today you had a little bit of follow-through selling. If you are in the camp that this is a head and shoulders top type formation, here's the left shoulder, there's your head, here's your right shoulder, here's your neckline. Just say you go from 70 to about 68. So from 68, you go to about 66. And what does that do? It takes you right around to the 100-day moving average, where some high beta names already almost touched, like Apple yesterday. So, I think you don't want to stay short all the way down to this. This probably is a good area to cover. As per my note, after 4 down days, probably a good time to cover. Doesn't mean, you can't continue the downside, or it doesn't mean you have to bounce, but sometimes you get a little retest up before, your continuation, down, if that's the way it's going to pan out. So with that said, look at the Qs breaking the 50-day. So if the Qs, which is leading the market lower, why wouldn't the SPX at least test it? Okay, and that's where we are, almost testing it. So let's hope tomorrow we get a nice setup where maybe they open lower and we could buy them, and that I think would be a setup that we all like. Or we get some kind of massive, red dog reversal where it opens up a little bit, trades through today's low tomorrow around 1430, tests, the 50. Sometimes it stops below, sometimes it pushes, through to get everyone out of their stops and then reclaims it. And, you get some kind of bar like this. And then from there, it should relieve some pressure, and then we'll figure out where the next area we go to is. As far as Apple, nice tactical long for the crew. This is when Apple changed, when it broke the 21-day, when it broke below 683. A lot of little trades in here. Last really good long was when it touched the 50-day the first time for about 20 points, and then sort of got, failed in front of these moving averages again. Then yesterday, we tweeted about it on the virtual trade floor. You saw that I got back long after not being in the stock for these 2 days. First time in a while not in there. I wasn't short, which I probably should have been when it closed below the 50-day, but at least I was just not trading it and saying I love Apple, I have to be long it. Instead, we looked for the right area into support for opportunity. So that opportunity happened. You had a nice trade yesterday, and then we talked about continuation above 640.49, and it wasn't blockbuster continuation, but there was a cash flow trade there. It did trade above it, went as high as, like I said, 645, about 4.5, 5 points above it. You look at the 5-minute chart, it was a bit choppy, but it wound up being a decent trade to the upside. Here is where, let's see where we are, in the course of today. Oh, actually, we got to go all the way back here. All right, so let's see. Oh, you know what? Let me go to sorry, I'm in the wrong little spot here. Here's your 3-minute chart. So, where is, oh, here it is. So you can't really see it in here. Anyway, I'm not going to get into it right there, but that was pretty much a strategy, and I do think that it can continue higher, and fill this gap and retest these moving averages that have been curling down, and that takes you to about 650. But if you only wanted to use it as a day-and-a-half strategy, that's fine. I'm not in there right now. I made a decision to be flat overnight. But the low today was 637, or actually what was it, 635. So that will be a nice spot that if it continues to hold this area for swing traders that bought yesterday, it's making it easy for you to hold. And then if we do open lower and it starts to get strong, today it showed relative strength, you could be a buyer above 645 for that extra push, to fill the gap there. As far as Google, a lot of guys were talking about it getting to the 21-day moving average, and it did. So for those of you who caught a nice little short, I think a lot of guys shorted it when it broke this number yesterday, when it broke below and stopped hovering and riding this 8-day moving average. We talk about trends, and trends are intact until they change. And this rode this all the way up into the first time it tested the 21-day and was a great buy. So it made sense after breaking down here for a short, trying to cover and look for a little long here. It wasn't a blockbuster type trade, but it was a good spot to switch gears. If you switched gears and were long and saw this small little outside day, not extreme, and got out, especially when the market failed, and then maybe even got short there, you had the luxury of testing longs here, and covering. And then we'll figure out if it could take back some of this day, or continues to go sideways for a bit more further downside. Because I would say this would still even be healthy if it got down to 720, considering where it came from. That our buy prices on Google were like at 620, 645, way back after earnings. Like this was your calculated buy price when it broke this downtrend, and this was your add-on. And then here also when it made a new high on the year, that was a nice little tactical play. So up here, not that big of a pullback. So just if you start buying too early, just realize where it came from. And the 50-day, which Apple broke and a lot of other stocks already broke, is all the way down here. So just have a bit of perspective. What I would do is I would trade a level versus a level. If you're long, be long if you're intermediate versus this low here. And if you're short and you didn't cover it today, make sure if it starts reclaiming 754, you get out of the way, because look what happened the last time it came in and tested the 21-day. It basically engulfed this entire little pull-in and then continued. And if that's the case, that means the market's probably not doing so bad either. Wal Mart pushed through, and then when they started to go over 2013, it came a little bit. That's a small sell signal, doesn't mean game over. Costco started out pretty strong, and this is a pretty ugly bar here. So to me, again, when stocks try and break out and get momentum and momentum leaves, you sell some. So sell some. Some people might have even got short, saying if it can't go up on those earnings, you might want to get short and say, I'm going to put a stop in at today's high, which is 104.43. So just be a bit careful. Trend is still strong. You still have, it's still above the moving averages. But anytime, again, when you break above and fail, this is a short-term sell signal. And I'm sure if you look here, you'll probably see some volume. You go to basic studies, you put your volume in, and look at the volume today. So here's a small outside reversal on volume. That's just the environment we're in right now. Sometimes you break out, you hold it, and you go. And then other times, you try and break out and fail. And typically, if you break out and fail, that means big money is using that for distribution, which again, another not healthy sign. The same way technology leading us lower, not a healthy sign. Chevron, I talked about in the morning call, something surprising. People were not thinking that Chevron was going to come out with bad numbers or guide down or pre-announce whatever they did. So it was one of those gap and goes to the downside. I think this stock, right there is a full-fledged avoid or short. I think a lot of guys, this was the level. I'm like, if it breaks 116, get out of the way. It opened below it, and look where it did. It closed at the lows of the day. This is what happens during earnings season, guys. You expect the unexpected. And this was unexpected considering it was at the highs almost of the year. So it was priced for perfection, let alone a pre-announcement. So where did it come in? It came into this old prior flag breakout point. So that just shows you how dangerous it is. You look at XOM also. I'm sure probably people said, oh my goodness, Chevron did that. Let me get out of the way on XOM. Let me get rid of some of the volume here because I like the way the chart looks the other way. And this one actually gave you a small clue that maybe you should get out of it. What did it do here? Broke out, couldn't hold it, went back below the prior high, closed near the lows. Some people might have been shorted as a small outside day. Granted, they were fighting a strong trend, because it did not break yet, but small little sell signal. Not a drastic one, but small. In the news today, everyone was talking about Home Depot, right? Home Depot got downgraded. Oh my goodness, call your mom. I don't know. All I'm saying is, there was a reversal pattern there on Monday, which was a clue to sell some. It's that king and queen's top. If you look at Home Depot, you'll see that I always talk about breakout failures, how that's a sign of distribution. Well, they squeezed the shorts into highs here and then closed through that low on Monday. That is a short-term sell signal. Tell me where in the past 2 months have you seen a drastic pattern like this, or even a potent down day like this that matched one of the prior. So that right there was a small sell signal. Then you had follow through yesterday, and then today was a downgrade. What you don't want to do is you don't want to be selling on this day after these two. Then you're always going to be behind the 8 ball, and you're not going to be creating too much alpha now at this point. It's into some support. It should see some lower prices, and I'd say there's some support around here, and then the 50 days moving up, and there you go right there. Bear in mind this stock was my retail stock of the year 2 years ago, and look at the move that it's had. So a little bit of a pull-in, put it in perspective. But short term, definitely some things to look at, some clues. Gold really not doing much, still struggling. It's holding the 21-day. Since it ignited back here in August, move up, consolidated, came to the 21-day, took off, went up. This one just went to the 8-day. Now it's been really doing some work up here. But, you haven't heard me talk about it ever since it tried to break out because there's really not much to do yet. At this point, I think it's still trying to prove that it could hold higher. It's still trying to prove that it can get, a bigger move, which is going to take a lot more power through this 1,800 an ounce because that's about where it is. But all in all, it's still in the upper third of this breakout range. So as long as it continues to hold up here, I know it might frustrate people because it's not going at the pace people think. This commodity is still acting better and could be on the way, to the highs. Because if you look here, it's not the same type of action. Remember this day when it tried to get above the highs and boom, potent down move, real potent, engulfed this entire range, and that's what helped lead to this direction to the downside. You're not seeing that here. You're seeing just a bit of a rest, a bit of choppiness, so there is some money still behind gold and silver. So with that said, there's always clues to connect the dots on when to sell into strength, when to have high-level stops, and the last thing you really want to do is sell right before you get some kind of fear type trade acceleration to the downside. Usually that acceleration to the downside doesn't mark a bottom, but it becomes buyable, kind of like what Apple did yesterday. If you didn't sell 683 or sell 660 or sell 652 and you sold it when it went below 630, you didn't really act too, you waited a little bit too long, and that's what we're trying to teach you not to do. Same way now, I have a feeling, after IBD went to rally under pressure yesterday, we have another distribution day today, they're probably going to go into market correction. Okay, so you really don't want to sell on the fourth down day, and if we open up tomorrow down, and you're like, oh, I got to get out, IBD now says we're in a correction, chances are you could have got out with better prices, because by the time we go in market correction, that means the oscillator is probably minus 50, minus 60, and that means we're typically ready for some type of oversold bounce. So I'd rather see you sell an oversold bounce versus hit out into a move that people bought wrong and just are getting stopped through. So with that said, oscillator was like negative 50. Okay, when we topped, we were at plus 60. So we're in a spot where I know, some guys covered today, which I do think makes sense. If you were short and tactically cheated short today because you saw the weakness in technology yesterday, congratulations. You're looking on, you're learning how to navigate the market. I would say on the close, hopefully you covered at least 80%. If you were looking long and you went to cash on Friday or a little bit before or even the last 2 days and saved yourself, 30 handles in the S&P, maybe on the close you went 20% long. Just in case we have another gap down tomorrow. If we do gap down tomorrow, I will be going in there with both hands because I do think that into that area it'll be a good trade. Might not mark a bottom, but I do think there's a good trade there. But I'm not willing to take it all overnight tonight because I just don't think you have to. It's not that compelling. So, but it also depends on your time frame and what you're looking to do risk-wise. So with all that said, a lot of bears claiming victory out there, like they're saying, "Oh, I told you so." But meanwhile, if you rode the rally from August and you maneuvered and used the tier system and managed your positions well and played breakouts, and on September 14th saw the oscillator screaming at plus 60 and said, you know what, I'm going to get from tier 2 or tier 3 down to tier 1, or you saw that choppy behavior when the flag broke, you're like, let me just get into more wait and see mode, and you didn't take 1470 down to 1430, 40 handles, your money's in the bank. You maneuvered the market well, you tactically used your time frame, and now you have the luxury again to figure out if this dip is viable. And with all that said, even if we go down a little bit further, we've had a 300 or so handle move since a year ago, where we're up over 15% for the year. So even if we closed up 10% or 12% for the years, in the books, it's a pretty decent book, especially in the wake of all the news that we've seen. But I'm not saying that yet. But I want to show you one of the pattern here real quickly. We talked about this. It's different than what's going on now in the S&P. And this is why I've been a bit cautious, or a bit more cautious. You remember this outside day here? This was the outside day in October. And then we had a huge move, okay, huge move. I think it was within 4 weeks, we went almost to 1,300, 200 handles. And then actively, we tried to measure what went on, okay? And if you look here, look at this wedge. Remember, it was wedging right here. I think everyone in the world started to get really, really bullish because we were wedging, holding in there. The retracement rules were in play, and then we failed to the downside. Okay, but on this failure to the downside, which got everyone out, what happened? Within 2 weeks, went right back to this area, and then the wedge just became bigger for what became an unbelievable move in the first quarter of this year. So here we are. It's October. So who's to say they're not going to play with things a little bit before they figure out if they want to make new highs in the year, or it's going to be set up for 2013. So with that said, that's why I'm being a bit more tactical now. If you look at these, even retracement rules with this move here from this low, okay, all the way up to the high of this move to where it came down to was a 61.8% retracement. Okay, if you look now where we are, putting things in perspective from the June low, okay. Just because I don't want to see people buy too early, or I don't want to see these, people say, oh, things are falling off a cliff, because they're not. If you go and put your Fibonacci retracements, we are just at the 25% retracement level right here, and typically 25% retracements are for the strongest markets and with the best headlines, with things going on. So we could still hit the 0.382% retracement and then continue. Okay, and that's 1397. So I'm not saying it's going to happen, but that's another 27 handles or so. So that's why I'm not saying jump in there with 2 fists when we're not seeing the signs of it yet. So at this point, it pays to be tactical, and that's the way we're going to be moving forward until we get a bit more clarity. So tomorrow I'll see you at the morning call with Jill. I hope everyone had a decent day. Apple was a great cash flow opportunity yesterday and today. There were others. And tomorrow I think we'll have opportunity no matter which way the market opens. Have a good night.
Hi, I'm Sean Hendelman of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.